Was another hot read on inflation today, with the consumer price index showing a startling 7% increase over the past 12 months. But will this prove to be the peak in inflationary pressures? Tendayi Kapfidze is the chief economist at U.S. Bank and joins us now. Tendayi, nice to see you. It's been a while. I think the last time we actually saw you was in our studio some time back. So nice to see you today. I think
Yeah, good to
investors are
see you.
trying to make sense of this inflation print. From where you stand, is this the worst it's going to get in terms of headline increases in inflation?
I think we might have 1 or 2 more months of really high prints before we start on the downtrend. But our expectation is by the end of the year, we should be somewhere around the 3% level. So we should get a deceleration in inflation, maybe starting in the second quarter and certainly in the second half of the year.
And Tendai, it's Julie here. It's great to see you. So as we look at the components of inflation, right, I was noting earlier that we saw food prices, particularly food at home, the increase moderate a little bit. But I'm seeing a lot of attention being paid this morning to the so-called owner's equivalent rent number. In other words, that's where the BLS tries to figure out if people were renting out their houses, for how much would they rent them out? And that number, according to some folks, is lower than it should be. How do you think about the housing cost as part of inflation?
Yeah, so it's interesting to me that some folks think it's lower than it should be. The OER is a really kind of interesting construct in that most things that are in the CPI actually have a cash flow associated with them. People actually spending money paying those prices. OER is not one of those things. So if you're actually a homeowner, your actual cash flow that you're paying is, your mortgage, taxes, maybe a condo fee or something like that. And if you think about the mortgage, which is the largest component of that, most people have a fixed rate mortgage, which means that cost never goes up. And then if you look at the past 2 years where we've had these record refinancings, people have actually lowered their monthly cost of owning their house. So, you could argue it the other way, and you would actually have data to argue it the other way.
So, Tendai, you're looking for inflation to decelerate. That's a good thing throughout this year. Within these components, what will get cheaper for consumers?
Well, once you have inflation, right, it doesn't, like for inflation to go away, things don't have to get cheaper. They just have to stop increasing. I think the biggest candidates for stopping increasing certainly is cars, used cars, new cars. If you look at, last December, if you think of previous years in December, you'd have all those promotions. I think one of them was like December to remember, and there were all these offers that would happen in December as car dealers, tried to hit their sales goals for the year. You didn't really see that last December, right? There's no discounts, there's no offers. You're paying more than MSRP for cars, and a lot of that has to do with the supply issues. We've started to see that ease a little bit, so we should get more new car production. Unfortunately, because of the lack of new cars, say over the past 2 years, there's not going to be replenishment of the used car supply, but we should start to see an easing in both new and used car price increases, which will help these inflation numbers significantly.
Also, maybe helping the inflation numbers will be the Fed tightening, right? At least that's the goal. It seems like the consensus at this point is for 3 rate increases this year. What are you looking for? And do you think that's going to be an effective tool at bringing inflation down?
So I think the interesting thing about the Fed is, if you go back a few months ago, nobody was expecting them to have 3 rate increases, right, in 2022. The Fed has reiterated many times that they're data dependent. So the way that I think about it is, sure, if the data requires them to raise 3 times, they might do that. But if the data changes, then maybe they won't. And there's a lot of risk to the economy this year. We're going to have a fiscal drag. You look at Omicron right now, we don't know what's going to happen with, say, January, February jobs numbers. When the Fed meets in March, they might be looking at 2 really bad job numbers because of the disruptions from Omicron. And as we go further out into the year, we have this fiscal drag. The economy will be slowing. So they're going to be hiking into a slowing economy. We don't know what's going to happen with the virus as the year progresses. So I think there is some downside risk for the economy. And therefore, the 3 hikes are not necessarily in the bag.
Tendai, do you think, just looking at what you were just saying about the slowdown, we have been hearing that from other economists too as well. I mean, do you think the economy is going to grow in the first quarter in large part because of the pandemic?
The first quarter is tough. I think there's some real risk that we might have a weak quarter. I don't know necessarily that it would turn negative. If you think about the third quarter of last year, at the beginning of the quarter, most people were expecting growth around 6 or 7%. It came in around 2.3%. So, that was about, 4 or 5 percentage points lower than had been expected just at the beginning of the quarter. So it's early days in January. We're having these Omicron disruptions, still don't know quite the extent of it, but we're starting to see some high frequency measures of activity show that it is having an effect in terms of things like restaurant bookings, number of people on the subway, for example, here in New York City. So, I think Q1 is probably going to come in, a little weaker than initial expectations. And I would say, yeah, there might be some risks that you could actually get it weak enough that it might be negative, especially given the strength that we saw in the fourth quarter.
So I'm coming back to, so this is an interesting portrait that you're painting here, that we could see weaker growth in the first quarter. We might not have 3 hikes coming from the Fed. I mean, it feels like people aren't necessarily positioned, and I know you're focusing on the economy more than the markets, but it feels like people aren't necessarily positioned correctly for that kind of a scenario.
So, I'm not going to tell anybody how to position themselves. But the way that I'm thinking about it is, we kind of have a base case expectation of what the economy is going to do. And every day I'm asking myself, what's the risk to this expectation? And I think the last 2 years have really taught all of us that, you really should approach these expectations with a lot of humility. A lot of things can change and change very rapidly. You just have to look at, the Fed itself to see how rapidly things change and the way that the Fed speakers are now addressing the economy versus, just 3-4 months ago. So in 3-4 months, again, going forward, I mean, who knows where we could be. So, I think, the base case is that, probably the economy is going to have another healthy year of growth. Probably we are going to get, a number of Fed hikes, maybe some balance sheet tightening. But there's a lot of risk and uncertainty to that outlook. And that's kind of what I'm trying to emphasize.
Tendayi Kapfidze, chief economist at U.S. Bank. Good to see you again. Looking forward to catching up again in the new year.